honourable company accepted, my experience of discussion of digital currencies is that the technology always takes centre stage, and the financial, economic, social and political implications are lucky even to get a cameo appearance. And CBDCs are no exception. There's been lots and lots of discussion in central bank circles and treasury circles and so forth about let's find a use for this shiny new technology, and little focus on what exactly we are trying to achieve. So along with other people who've spoken already, I shall concentrate on two fundamental questions, which are what forms of central bank money do we need, and who should have access to them? So let's start by discussing what forms of central bank money we currently have, what technologies they use, and who has access to them. Central bank money currently takes two forms, notes and coins, and bank reserves. These two forms use very different technologies. Notes and coins are physical media, historically made of, respectively, paper and metal, although paper is now giving way to plastics. Bank reserves are the ledger balances that banks hold in their reserve accounts at the central banks, which are banks' equivalent of the current accounts that we all have in commercial banks. Those reserve balances are electronic. The days when bank clerks recorded reserves in dusty ledgers with quill pens are long gone, and so too are the days when banks held physical gold reserves in vaults. These days, bank reserves are numbers on a computer. Both forms of central bank money are primarily used for transactions, and both also have a secondary function, namely saving. But the two forms serve entirely different audiences. Notes and coins are used by households and businesses. The electronic bank reserves are used exclusively by banks. The electronic money used by households and businesses is created by commercial banks, not central banks. The two forms of central bank money are different in another way too. Notes and coins are bearer instruments. They are not assigned to a named individual or business, but are owned by whoever happens to hold them. They are anonymous and untraceable, mainly. For this reason, they are easy to use for crime and for black or grey market transactions. The downside for the private sector is that storing and moving large amounts of physical cash is impractical and can be costly. Holding cash is a considerable security risk, and for businesses, there's a need to maintain float and physically deposit cash in increasingly scarce bank branches. Bank reserves, however, like current accounts, are assigned to a named bank. It's not possible for a bank to use bank reserves if it does not have a reserve account at the central bank. And it's not unusual for smaller banks not to have reserve accounts. If they don't, then they must rely on larger banks that do. In the United Kingdom, larger banks that provided payment services for smaller banks used to be known as clearing banks. In the United States, some state-chartered banks are currently fighting the Federal Reserve through the courts to force it to give them master accounts, or what we would know as reserve accounts. Cash, therefore, is accessible to everyone, but access to bank reserves is limited and at the central bank's discretion. This distinction has become a major battleground in the debate about what type of CBDC we should have. There's actually no need to have this argument at all. After all, we've happily had two types of central bank money for generations. There's no particular reason why we couldn't have two types of CBDC. One, a digital version of physical cash, anonymous and untraceable, and the other, reserve accounts at the central bank. Sadly, the state of the present debate about CBDCs is that digital cash, anonymous and untraceable, has pretty much been ruled out because no central bank, apparently, should be allowed to issue an instrument that could be easily used for criminal transactions and for black and grey market activity. Quite why policymakers have suddenly become so concerned about this when physical cash issued by central banks has been used for exactly those purposes for centuries is something of a mystery. Personally, I think there's a case for central banks to issue digital bearer instruments for use in our growing digital economy. These would not suffer the impracticality and storage costs of physical cash. They could potentially be considerably more secure. And businesses would not need to hold float or physically deposit money in banks. However, there would be a considerable social cost to replacing physical cash entirely with such an instrument, since using it would depend upon having access to electronic media. This creates obstacles for some groups of people, such as the elderly and people with disabilities. And perhaps more worryingly, it carries the risk that if the electronic media fail, people may be left with no access to their money and no means of obtaining supplies. as we've seen recently, access to electricity and to the internet are weapons of war. We should be cautious about making our monetary system too dependent on these. So now the debate has become, should we change the technology behind central reserves and settlement, and should we give households and businesses central bank accounts? You notice I haven't used the term CBDC. That's because bank reserves already are a CBDC. The debate is all about what technology our existing CBDC should use and whether the current restrictions on who can access it should be lifted. When people talk about CBDC technology, they almost always mean blockchain. So I think it's worth spending a few moments, I don't want to take too long on this, outlining how the current technology works and considering to what extent adopting blockchain technology could improve, or not, the speed, cost and security of mainstream payments. In advanced Western countries, and in a growing number of developing countries too, electronic payments are settled across central bank real-time gross settlement systems. These systems use traditional double-entry accounting. The movement of money is recorded by simultaneously posting equal and opposite amounts to the central bank reserve accounts of the sending and receiving banks. Because these postings are made simultaneously, the implied movement takes no time. The payment is instantaneous. Blockchain technology is fundamentally different. A blockchain is an append-only digital ledger which records the movement of digital currencies from one address to another. It does not record the ledger balances held by each address, though this can be calculated by adding up all movements in and out of that address. And this is the polar opposite of a double-entry accounting system in which the movement of money is implied from the changes in ledger balances rather than explicitly recorded. Interestingly, back in the 1980s, when I was a young IT professional working in a major bank, we changed customer accounting systems from single entry to double entry. The early bank systems of the 1960s and 70s had been designed by techies who didn't understand accounting. Blockchain is similarly designed by techies who don't understand accounting. It seems more intuitive to think of money changing hands as a movement rather than a change in ledger balances. After all, if you pay for goods with physical cash, you get notes and coins out of your back pocket and you hand them over to the retailer who gives you the goods and then you change. And this is how blockchain works. It recreates digitally the movement of physical cash in a face-to-face transaction with no intermediaries. There are two types of blockchain, permissioned and permissionless. The most familiar blockchain-based digital currency, Bitcoin, is a permissionless system. Anyone can access it. All transactions are public. Addresses are anonymous. A complicated and extremely expensive verification process prevents fraudulent transactions. Above all, there is no central authority controlling it. It runs itself. A permission system is private. Access is restricted to those granted permission by central administrators, and typically verification it may be community-led by members of that permissioned community, or it may just be done by the central authority, but it is not the decentralized anonymous system of a permissionless blockchain, and it therefore doesn't have the expensive verification processes either, as we were discussing at the break. It should be obvious that a blockchain-based CBDC replacing bank reserves would not be permissionless. After all, anything issued and controlled by a central bank is, by definition, centralised. But a permissioned blockchain is really only a shared database, and that's what the central bank balance sheet already is. We're back to, we've already got a CBDC. RTGS systems are often criticised for slow and expensive settlement. The argument is that replacing them with CBDCs on a blockchain on permissioned blockchains which interact with each other, would make international payments particularly faster and less expensive. But what takes the time and causes the cost is not the way the accounting works. It's the limitations of the physical hardware that necessitate batching and netting. The limited time windows at central banks, because they're run by humans and humans go home. And above all, the layers of security checks performed by banks, payment companies and central banks. All of these can, of course, be improved, but they can't be completely eliminated. There isn't any hardware in the world that can simultaneously settle trillions of payments at the individual transaction level, and no government is going to allow its central bank to settle payments that could be fraudulent or break its rules. And whether we like it or not, time zones exist. For foreign exchange transactions, the continuous linked settlement system simultaneously settles both legs of a foreign exchange transaction across the real-time gross settlement systems. for the relevant currencies. So, for example, a cross-border payment from a dollar account at a US bank to a sterling account at a UK bank is settled simultaneously by Fedwire and CHAPS. CLS waits for all member central banks to be online at the same time and settles all FX transactions within that fairly small time window. This eliminates Herstat risk, which is the risk that one leg of an FX transaction will fail to settle because of a bank failure in the time zone difference. But it does significantly slow down FX settlement. If an interoperable CBDC-based system could make it possible for foreign exchange transactions to settle 24/7/365, international payments could be much faster. It's not at all clear that such a system needs to use blockchains. Recording the movement of money in a transaction cannot be any faster than simultaneously recording the change in the ledgers at both ends of the transaction, and it cannot be any less costly. And interoperability does not depend upon using a particular technology. It's largely a matter of common standards. Changing from double entry to single entry accounting is not going to speed up central bank settlement, and it could be extremely disruptive. You only have to look at how difficult it has been for those dealing with failed crypto companies FTX Celsius and 3 Arrows Capital to find out where the money has gone, to realise just how much a blockchain-based system complicates financial management. We should not make such a change lightly. Widening access to central bank reserve accounts, if I move on to that now, and I'll wrap up in a minute, doesn't depend on introducing a new CBDC, whether blockchain-based or not. It could be done using existing technology, but it has profound and far-reaching economic, social and political implications, many of which Kevin has already covered. Whatever technology is used, giving households and businesses central bank accounts would be a form of what is known as sovereign money. A nod to Samuel wherever he is. In its most extreme form, this would strip commercial banks of their ability to fund themselves with deposits, since households and businesses would prefer to hold deposits at the central bank rather than in commercial banks. The consequences for lending could be dire. For this reason, most proposals to widen access to central bank accounts restrict either the amount of money that can be held in the central bank account or the purposes for which the money can be used, or both. Calibrating the right level of such restrictions is not easy. A limit on the amount of money that can be held faces similar problems to deposit insurance limits, if you've been looking at the debates around those recently. Too low a limit makes the account unusable. For example, an early CBDC proposed from the ECB set a limit of €3,000, which is far too low for most businesses and some households. I couldn't have paid my tax bill with that. Rather worrying that your sovereign CBDC can't be used to pay your taxes. And too high a limit disintermediates banks. Banks, of course, have the option of raising interest rates to attract deposits, but this would have consequences for monetary policy. The interest rate on the CBDC would become the effective floor on the deposit funding rate for banks, and hence would influence the price of lending in much the same way as paying interest on reserves does now. I have seen proposals to set the CBDC interest rate permanently at zero, but in my view this would distort monetary policy, since it would encourage banks to keep deposit rates permanently low and simply adjust lending rates in response to central bank interest rate rises. It's not clear to me why we should subsidise banks at the expense of depositors in this way. Furthermore, continuing to remunerate bank reserve accounts whilst paying zero interest on the CBDC used by the general public would be grossly unfair and politically unsustainable. There's also a problem with deposit insurance. Most sovereign money proposals assume that deposit insurance would no longer be necessary because the central bank is not at risk of liquidity crisis. But maintaining deposit insurance might be necessary to protect commercial banks. Without it, there would be runs to the central bank at times of financial instability and political pressure to raise the CBDC limit. As we've seen this year, in times of financial instability, protecting all depositors from loss becomes the imperative, and the need to maintain productive lending becomes an afterthought if it's considered at all. Restricting what can be done with a CBDC has profound implications for civil liberties. As Kevin has said, if a government can restrict what people do with their money or even who can get access to the monetary system, it's appalling, really. Government should have the power to shun in that way, to lock people out of the monetary system. We should think very hard before introducing as the sole or main medium of exchange a form of money that is so easily controlled by government. Our burgeoning digital economy does need its own form of money, and it makes sense for this to be produced by a central bank, not least so that the digital economy remains embedded in the wider macroeconomy. And updating RTGS technology is clearly needed, particularly for international payments. But current proposals of CBDCs are going in the wrong direction. Political fears and objectives are dominating the discussion, and the independence of central banks is once again being subordinated to the understandable desire of politicians to control how people use their money. There is value in a digital bearer instrument similar to physical cash, and I don't really see why an independent central bank shouldn't produce such an instrument. But extending central bank accounts to households and businesses is fraught with political, social and economic problems. I am yet to be convinced that the benefits outweigh the very considerable risks.